A business transaction is an economic event that directly affects two or more of the elements of the accounting equation. Every time a business transaction occurs, its effect on the accounting equation must be recorded. On November 1st, 2011, Chris Clark begins a business that will be known as Net Solutions. This lecture will illustrate how transactions change the elements in the accounting equation. The first transaction is a deposit of $25,000 into the business bank account. This transaction will cause both the asset account, cash, to increase, and the owner's equity account, Chris Clark Capital, to increase by $25,000. After recording each transaction, the accounting equation must still be in balance. The total of the assets must always equal the total of the liabilities plus owner's equity. In the next transaction, Net Solutions exchanged $20,000 for land. This transaction affects two different asset accounts. The asset account, cash, is decreased by $20,000, and the asset account, land, is increased by $20,000. The total assets are still equal to $25,000, although the composition of the total assets has changed. There is no effect upon the owner's equity account, Chris Clark Capital, because exchanging one asset for another has no effect upon the owner's claim on assets. The owner's claim on assets is $25,000 both before and after the land is bought by the business. In this transaction, the business purchased supplies on account. Therefore, the asset account, supplies, is increased by $1,350. The business will pay for these supplies in the future. Therefore, a liability account, accounts payable, which represents amounts the business owes to suppliers, is increased by $1,350. This transaction causes the total assets of the business to increase by $1,350. At the same time, the liabilities of the business have increased by $1,350. This transaction has no effect upon the owner's equity because, although there has been an increase in business assets, there has been a corresponding increase in creditors' claims on assets. In this transaction, Net Solution provides services to their customers, receiving $7,500 in cash. This transaction is recorded on the asset side by increasing cash by $7,500. The increase in assets is recorded with a corresponding increase in the owner's equity account, fees earned, of $7,500. A transaction with a customer represents revenue, which increases an owner's equity in the assets of the business. Total owner's equity is equal to $32,500 or $25,000 plus $7,500. Different terms are used for the various types of revenues. Expenses include supplies used and payments for employee wages, utilities, and other expenses. Expenses can be paid directly in cash, or payment might be made in the near future, called on account. For this transaction, Net Solutions paid a total of $3,650 in cash for 4 different expenses. Therefore, the asset, cash, is decreased by $3,650. On the right side of the equation, the payment of expenses is recorded by decreasing owner's equity for each expense paid. Owner's equity will decrease by $3,650 for the total expenses paid during the month. In this transaction, Net Solutions pays $950 to its creditors in payment of the account payable that was set up when the supplies were purchased in Transaction C. This payment affects the asset account, cash, which is decreased by $950. On the right side of the equation, the liability, accounts payable, is decreased by $950. Paying off a debt reduces the creditor's claims on the assets of the business. During the month, supplies needed in running the business were used. The business does not record the usage of supplies on a daily basis because it would be too time-consuming. At the end of the month, the asset account supplies must be updated to reflect the balance of the supplies that are still unused or on hand. Therefore, they count up the amount of supplies that remain, in this case, $550. Since they began the month with a purchase of supplies of $1,350 and only $550 of supplies remain by subtraction, $800 of supplies, or $1,350 minus $550, must have been used up during the month. The business records this transaction by subtracting $800 from supplies, reducing the supplies account balance to $550. On the right side of the accounting equation, The usage of supplies is recorded by subtracting $800 from owner's equity. This is called supplies expense. It is an expense because supplies are used up in the process of generating revenue. When the owner Chris withdraws $2,000 from the business for personal use, the asset cash is reduced by $2,000. On the right side of the equation, this withdrawal of cash paid to the owner from the business reduces the owner's equity by $2,000. In the summary listed above, you should note the following points. Every transaction is an increase or decrease in one or more of the accounting equation elements. The two sides of the equation are always equal. Owner's equity increases with investments made by owners and decreases by owners' withdrawals. Owner's equity will also be increased by revenues earned and decreased by expenses incurred.